Hi, I'm going to do an ad hoc, almost evergreen video on a concept regarding your trading that I think many people overlook as retail traders, whether it be in the crypto space, equity space, the currency space. In fact, I think we're one of very few people that actually address this. I don't know of a single other aspect or trader or on the Twitter feed that talks about the concept of what we're going to discuss today, namely time stops. So I'm going to do a whiteboarding baseline introduction. We go into far greater detail in our premium area on our studio recorded content. This is Jumpshare. We do full studio recording with slides, etc. on that, and we drill down right into how we utilize it in HVF method. But not all of you in the program, not all of you can afford to be in a program, and you might still want to get some value out of the concept of time stops. So let's discuss it. Time stops. This is what we're talking about today. Time stops. What does that mean? Well, it means in essence a closure of a trade on account of how much time has elapsed. Now I want to just highlight to many of you that's something that you don't actually think about necessarily very much, and that is the simple fact that a chart is actually two axes. And you might go, what? We know that. Yep. Two axes, one which is your price, and the other one which is the elapsement of time. So they have price, and most of us are always concerned and make decisions based on price. And there is this other axis that gets rather neglected. And in fact, when we have, for example, you're in a long position in the market, you would actually have potentially a take profit target. I would certainly suggest that you have such things. That's the only way to have a risk reward ratio known to you prior to entry. So you will have some form of take profit zone. In fact, we don't usually use green. We use green for entry points. So let's go. Purple is our targeting zone. Let's say you were long in this instrument, and at some point you used ideally not a market order, and you waited for a triggering event, in which case you went long on this green line at some event when that price level was crossed. And the minute that happened, you had an active stop. This is specific for leverage trading generally. So in other words, there is some degree of risk or potential for further damage to you if a market fell significantly. Hence, stops are just a non-negotiable if there's any form of borrowed money or leveraging up. So most people that are retail traders are utilizing some degree of leverage. Now the flight path, if let's just take the orange color as a flight path, let's say you were triggered long in your trade here. When this you were watching it, it was triggered long and then it came back up. You had a limit order and you were triggered long, and off it goes. It looks like it's doing great. It's making some progress, and then suddenly it starts to get a bit gassed out and it's churning. But it hasn't run your stop down here yet, which I'll extend given this illustration, and it's still above, but it's kind of churning around, and it looks a bit more listing as a trade. It's kind of a lackluster, and what typically tends to happen is that people end up hodling. The original reason for the trade idea that existed when you were triggered, so let's just go and capture that triggered moment. When it occurred in the luminous blue, you were watching this market and you said, great, that was a great setup. That's where I'm triggered. There's my stop placement below the previous low, and here's where I expect it to go. And in that process, the original setup, there was a reason for it, I hope. Our primary reason is HVF method, the Hunt Volatility Funnel. You can learn more about that, just pop over to the website. But we look for volatility constrictions with highly expansive volatility later expansions, which lead to very big rewards with tight stops. And that means you can be stopped out quite regularly, but you get much bigger harvesting periods when your rewards are taken. So you will have your own reason. It could be a head and shoulder, it could be some other traditional technical analysis pattern, it could be some other piece of analysis, Wyckoff, Elliott wave, etc., etc. But the point is your target is not run, and you've had a bit of progress, and now you're having a pullback, and essentially this orange level could stay in between your stop level, which could be extended and extended into the very far future. And in a similar fashion, I will freestyle draw even the profit level. You could have much the same thing going on and on and on. And people just start to portfolio or hodl leveraged trades. Now, you should not have a portfolio of trade. You can have a portfolio of investments. Leveraged trades should not be portfolioed and become long-term holdings when you're using any form of reasonable leverage for maxing your return. You should do leverage trading only when you have high certainty and a unique set of circumstances that give an above average likelihood, in fact, extremely high probability of outcome. It's never extremely high, especially if you're looking for it, but a higher than is normal probability of outcome, and with a very generous reward where you can have very tight risk. Those are the moments when taking access and earning the right to leverage, being selective in doing this, not exploiting it, not always being net long Bitcoin because it's only a bull and you bought all the macro fundamental reasons, and then you get 55% corrections that crush you, such as the liquidations. Now, what happens on crypto also happens in .com and happens in even smaller markets. Like, you don't have to be in GameStop or AMC to have that happen to you, and liquidations. So here's the key reason why we look more at time as well as price, and we focus on it. Let's take a step back, and we'll come back to the scenario that I've sketched out for you. Three reasons why we do time stops in terms of our method. And whatever method you have, here's three reasons why you should consider having it in your method. So one is trade management. And that's in trade management. So that's once you are committed to a particular view or position, you've been triggered into your trade and you're now long or you're short. What do I do? How long do I let this run if it's not yet doing either my stop or my take profit? There's another reason why we do time stops, and that is the actual analysis. That's why we look at time as a vector, and we also do analysis and feedback on it. And that is because when you start looking at patterns and structures and you're drawing previous patterns and structures, checking how it has performed in terms of not just price but time frame, how quickly was the outcome attained, if the outcome was attained. If it wasn't attained, did it then subsequently fail? All of this is part of your market analysis and market feedback. Market analysis and feedback. In short, when you're analyzing a particular market, let's say you particularly like oil and you think the big macro inflation trade is the trade, we talk about it a lot on YouTube, etc., etc. You start to see upward-based patterns that look like continuation patterns. Assessing the time performance element as well as the risk to rewards of individual trades. How quickly is it done? Having a matrix for that is feedback as to the strength of that trend or the building exhaustion. If it's coming late in a trend and it's really languishing. Languishing trades mean the original reason for the setup has started to hit into countervailing forces potentially that are getting strong enough to stop its progress and also causing its progress decay and may subsequently lead to its trade failure. Now, once our time stops are run, we close the trade at market. That means we don't hit a market order. We try always get out on a limit. Limits are your friend, but we define the range, get very close to the bid and ask, and look to close the trade. And what we have found is that many of our structures and patterns, if they have passed their time stop, and we have specific geometric reasons in terms of how we set a time stop that is generated from the pattern structure, and you can decide your own methodology as well. Remember, a time stop for a 15-minute trade will not be the same as a monthly chart trade. or a 4-hourly trade or a daily trade. So you want to bear all of those things in mind, and that's something for you to think about and solve. We already have a structure for our primary method of trading. But nonetheless, it's feedback if you are starting to lose momentum and taking an extended time. And most instances, after we've closed in time stops, when we observe, the trade would have ended out being a stop out. So what that often does is lackluster trades that get closed on their time stop, let's say the time stop is here, lock in whilst not giving you the total amount of R's you would have made if you'd done the total profit from your green line to there. They end up giving you often 60, 70, 80%. Let's say we close there, that line's a little low, of your R's, only to subsequently fail later, which would have been a later stop loss event for you. More often than they do the opposite and subsequently make your target to the upside after your time stop has passed. Now, we have a very specific set of criteria for that. You can find out how we do that by joining our community and looking at our advanced content and our intermediate content on HVF method. But you might not want to do that. Fine. Determine that for whatever you are doing as a trade. Third reason why we have time stops. Time is money, by the way. Always is. It increases your trader efficiency. So what does this mean? It stops you. So increased trader efficiency. Increased trader efficiency. You become a better trader. And the efficiency is certainly meaning you do not build long marriages of convenience trades that just linger on, like bad relationships that shouldn't be there, that just you become comfortable with having that old position on. And I can tell you, rarely, once they've not performed in what you would have normally expected as a time frame, do these turn into good things. You usually end up closing them on pain or at your stop loss if you're an organized trader and have such a thing. So it kills hodls for trading. Trades are never hodls. Investments can be. Remember the difference between investment and trading. One is key element, might be time frame, but the most important part is in leverage, is utilized in trading. Investments, if you own it all, you're a full believer fundamentally in it, good luck, you hold it, and your faith may or may not be rewarded if your fundamental reason is realized. If it's a technical investment, then you are chart-based. You should still have a point where you accept you're wrong, even as an investor. And in my worldview, even for investing, you should have a timeline for when certain things are required. It can be a very long one. For example, for me, on physical holding of silver, I don't have a short time frame timeline. I am looking post all forms of economic collapse and reset, which could be 10, could be 15 years. It could be in the next 3 years. So my long stop date for those to come good is pretty lengthy, that many will consider it open-ended. It should not be open-ended. It should still have a date. Past 2030, in my humble opinion, the reset of the financial system has probably occurred. The max blow-off of silver might take 2 or 3 years, even beyond that, as the new system is introduced. So 2035, I will make a decision if I want to continue to hold bars of silver and other physical precious metals or not, and take whatever's on the market price at the time. Okay, so increased trader efficiency. What else will this do? So you will keep culling languishing trades. That returns your capital to you faster and gives you a new opportunity to utilize that capital more efficiently on a fresh setup that may perform promptly to its target, instead of languishing old friends that have become frenemies and are actually costing you. So as we move to cost, let's talk about other reasons why you should in fact bear in mind time. So let's change color in fact on that. We'll go to the blue. I'll fatten up a little bit. 2 reasons why you should be considering time. and I've touched on them, but they need to be handled properly. The carry cost of a trade. Now, carry costs can vary. Many of you will, especially where, again, leverage is used, even if it's very light. Brokers like to make money, and they don't just make money on the spread. They make money on a funding charge in some form or another, on a CFD interest charge in some form or another. On crypto, the tether borrowing rate will be adjusted, especially in bull markets, and will start to climb in very high demand periods. Every moment that you have that trade open, typically where there is a typical trade dynamic, a spread better, a CFD provider, an option, all have some form of time decay in them in terms of cost to you for every moment that it's being held. And it's very common for traders to become numb and forgetful of this. You have an open carry cost. It is a case of perform or die. Your time is up. And you need to have that line in the sand where you say the realistic time for whatever my setup or reason for buying there and for expecting an exit there and having a stop loss here is up, and therefore I close efficiently on limit orders as close to the market as it is to ensure that I exit. And I monitor that until the position is closed once my time stop is run, because it's costing you every day. We get numb to those daily alert emails that tell you your P&L movements. We often don't check them if we've not made any new trades. It's only at that point we usually check them to see that they're still there. Usually you can see it in your blotter, etc., etc. You become numb to the whittling away cost of time. Now, I just want to highlight to you when the Turkish lira, the Central Bank of Turkey has set its percentage at 19% in an environment that the dollar and most other macro global currencies are well sub 1%, barely above naught. This has an incredibly high cost. In fact, when I did P&L analysis for my previous year on a single spread bet account in the UK, I had a total cost of £180,000 in carry costs on that account. It's quite a big account, it's fairly active. And in fact, 90,000 of that 180 was that one particular USD try. But even if I eliminate the trades that I took on the Turkish lira, £90,000 is a lot to be paying just to keep trades open. That's not the spread that they made off me. That is just financing and funding costs. This all comes out of your annual year's P&L. Yep, that's right. Your P&L carries a lot of the costs. Now, you won't be running up costs like that with a 10 or a 20 grand account or a 30 grand account, but I can tell you, as a percentage, you'll be shocked when you see your annual P&L and you see what you paid in funding costs for all your activities, including your losing trades, remember. The funding costs are ambivalent to whether you make money or not. Hence, the value of time stops. It will save you an immense amount on your funding. Do your annual year reviews of your accounts. Accumulate from all your statements. Do a download into a CSV file and add up your costs and have your eyes opened. Go and do it. Okay, the other one is opportunity cost. This is not a direct cost like the funding cost on your CFD, the devaluation of your option on a basis of time decay, the CFD's funding rate, the Tether's funding rate when you're crypto long Bitcoin or Ethereum. This is an opportunity that you couldn't take because you're inside your maximum limits for your margin. You could have a big move, you could get a margin call, you can't add any trades. But there's a fantastic new, fresh opportunity which may have high momentum that may go all the way to target promptly and quickly and efficiently that you are not able to take on account of you being fully bases loaded. The problem I notice with new traders is that they always seem to have their full allocation on all the time. There's never powder dry. There is never powder dry. Another separate point for retail traders that is not related to the cost, but keep some powder dry. Have some space in your trading home with resources and liquidity that is not committed. Unless you just think for the year you married the first girl that you saw. It is the same. You've just shot all your bolts in the very first week of the year, and now you sit and wait for them all to perform, and then the mother of all setups comes and you now have a problem and you watch it perform beautifully because you've kind of got your trades on and you're scared that if you close it, it'll perform now, and you've got this issue. Your bases are loaded and you haven't kept powder dry. That is not a funding cost. It's just a back out point. I should put it with B and call it B1. It's kind of a back out point on opportunity cost. Understanding the cost of not being in another good, fresh opportunity if you have a languishing one that is taking one of the chairs at your table. Okay, so that's another reason why you do it. Now, we do time stops that are geometrically determined on the HVF setup. That is part of our advanced material. So that is something we'll get into if you ever elect to come on board with us. So I'm not going to drop down into this. I'm just trying to give you some thoughts. By the way, we even have, just for your awareness, time progression points on our setup so that we can analyze when a particular trade is on time to its target or is lagging or performing above expectations for an on-time performance. So knowing in advance how much time you have for this risk reward. So remember, we've highlighted this risk reward relationship where, let's cover the green. That is your reward. Let's draw, not move everything around. That is your reward, colored in green, expected on an on-target performance. And then your risk over here, which is over there. Let's say this is a 1:4 risk-reward relationship. We've introduced inside of our methodology, just so that you're aware of, apart from having interim target levels, interim time frames for when those interim target levels should be met. And this gives you a flight path that tells you whether your trade is currently on time, ahead of schedule, or languishing. It's very, very useful. And I don't know any other methodology that provides interim levels so that you can expect a pullback where you expect the market to pause. And I certainly don't know any that give you on-time performance for your target. So the benefit of this is, instead of just being a methodology that refers to risk-reward ratio that is fully known prior to the trade, we can also retrospectively, once we've got our performance, divide by the amount of time out of the possible allocated time, maximum allocated time we've utilized. So you get a new degree of efficiency in your trading. In short, something that performs on time uses 100% of the time available. That is 100 over 100. If your risk reward was 4 and then you allowed X days and it took exactly X days to do it, then your RRT also equals 4 because you are dividing by 100% over 100 over 100. You used 100% of the time. However, conceptually, imagine you could get trades that maybe the RRs aren't getting higher, but they are more likely to perform quickly. And instead of taking 100% of the time, your RR on Mr. Fast Shoes is 50 over 100, and it's the same for risk-free ratio. You actually get an RRT, which is times 2 equals 8, because 50 dividing by 50 over 100 is the same as multiplying by 100 over 50. So whilst the rewards and the risk ratios are identical between these two, what you're actually getting performance-wise is you're getting your capital back to flip it over again faster. Your trade is closed here. The time between here and then could be in another one of these trades. It could be in a loser next, because you will always have losers. But the point of the matter is the return of capital reduces the carry cost that should be taken out of your P&L and is being done normally on a day-to-day basis on your spread better, your CFD. The value of the time left on your option is much higher. Your option has a time decay if you bought calls like that, which comes really hard down as you get to expiry. Comes slowly down and then hard, kind of like how you pay your mortgage curve off. So those things are really, really significant and underestimated. Now, if you have any friends who are car dealers, for example, and that is a depreciating stock, by the way. So car dealers know when they bought a lemon and it's not quite right, they don't try sell out at maximum price that a retail guy who owns the car, loves the car, thinks his car's the best example does on Auto Trader. They knock it out 5% below market so that it moves quickly. And they recognize their mistake, they take their knock, and they get the capital back in. They may only make half their margin, a third of their margin. Some will even do it on a loss if they've bought badly. If you're in the second-hand car market and you see something, or there's been a major change on the model and it's not moving, the minute that car's been sitting a little long on the stock, customers even see it there too long. Nobody wants to buy it. They perceive it's wrong. You swap it out, you get it moved fast, quickly somewhere else. And that is how car dealers operate. It's far better than trying to get maximum price on 2 or 3 cars sold at full value according to what the market is roughly indicating, and making full profit. It's far better to flip that capital 10 times, making 3/4 of that profit. So the money keeps coming back and is giving a yield, and the stock is turning over faster. So the maximum R's are great, but you don't want to sit with your capital locked up for 5 years when oil's going to go through the moon, Bitcoin's going to go through the moon, all these things are going to go through the moon. You have to look at both your carry cost of being 100% engaged in the market for an extended period, and you also have to look at how's the carry cost going to be on that Turkish lira trade at the difference of interest of 19% to a 0.1% plus every time there's a panic and they really try to squeeze retail traders and reduce leverage and they push it through the moon, because those will all take away your profits. One trade category, one FX pair cost me £90,000 in a single year. Yes, it made quite a bit of money, but still that was a big shave of the profits on there. So here you have 2 trades with a similar risk reward profile. One might be early in a trend and super fresh and likely to overperform quicker. One might be late in an already established trend, getting a little bit leggy, that gets closed on a time stop, and you end up not actually getting the full 4, you end up getting, say, 2. And if you held it, you would have got -1 because you would have had 1 full unit of loss on your risk reward, plus extra days of carry costs. So you would have made a loss and got carry costs. So everything would have been a waste on that unit. Hence the value of a time stop, and hence the value of potentially having criteria where you assess not just the risk reward ratio, but the probability of outcome. So your best trades, let's write this down, are going to be a combination of RRR times the probability of outcome. We have begun and we are scoring what are our best criteria for our specific setups. But it's a lengthy process and it's incomplete. So we have guide for now, and it's something we continue to pour resources into, but we definitely know all our risk rewards before we enter. This is a key variable which we're developing, and then the likelihood of speed, the time for which your capital comes back. Because if it's going to be tied up for a long time, you have to minus your, you have to minus your time times your daily carry cost from any profits made. Carry cost. I'm hoping you appreciate this. This is your clocks. Have these clocks in your head. Time is money. Time is money. So do you have a method? Do you have a setup? Do you have a reason or a structure whereby you can set for different time frames of attractive criteria that are giving you good risk rewards? where you can assess both your probability of outcome and the freshness of your trade for its speed of execution and your risk rewards. And two of those you should have an idea about quite clearly. You should know very specifically your known risk reward. Bear in mind, we have allowances for unique occasions where we will allow for overperformance. Those are determined by the setup and are known in advance. So we get the minimum, on those particular instances, we get the minimum, the R, and then we will allow overperformance. And that's the only time we don't have a time stop, because we have exits of another nature which will have to be hit that imply a natural gradient of ascent that the trade will continue to have to perform to, which is superseding the carry costs and giving supernormal profits, for which the minute it fails to do that, it is closed. So that is exceedingly powerful, and that's unique to HVF method, by the way. You can learn more about how we do that with our overperformance bands. Probability of outcome will be a guess number now. You won't know it absolutely. This is hard. This is anecdotal soft, and you will see, but it's hardening up with the research we're doing in that space. And then time is also anecdotal soft, but also hardening up. We are monitoring the circumstances under which our favored setup occurs, whereby the best speed-based outcomes typically occur. And it's usually early ones. So that's a clue for you. In other words, setups early in a new trend, not one late in a new trend, or very big time frame ones where there is no clear established trend. So monthly setups where it's taken 10 years, 5 years, 3 years, which is why Bitcoin's 2.5 year for its 10-year lifespan is a very interesting continuation pattern. See what we refer to as First Cup Gold Nugget on our crypto channel. Okay, so we've given you a couple of thoughts on there, and we've introduced the concept of RRRT divided by T, which means the faster it performs, actually the value of the trade is no longer just about R's, it's a new value. It doesn't mean you've got twice as many R's. It means the trade is worth twice as much than that one, because it performs in half the time. That if you had an equally good one that you could roll it straight into, you would attain the same number of R's again in the same amount of time. So RRRT is no longer a pure risk and reward function. It is a trade attractiveness function on a basis of time. The T is only known in finality when you see the target taken. It can be guessed anecdotally with soft evidence, and we have criteria that we are building for both of these. These are the variables that you can often never pin down entirely, but you can certainly get to key points and observances of when they will serve you best in terms of time frame. By the way, this works both for bears and for bulls. So I've shown you a simple example on a bullish front with a very basic draw here, a sketch. We've done actuals in our premium content with inverteds and upsides on our unique setup, which is of course the HVF method setup, and you're welcome to, as I say, engage with us further if you would like to see that full studio recorded content. Finally, this concept of time stops is not specific just to our particular method. It could be used on anything. So what I've done here is I've given a very basic example, and I'm not sure if I want to delete all that. Maybe I will. You guys can screenshot this, or let's take a screenshot just in case. We can make it a thumbnail for this video. If you find this valuable, by the way, and you like the sharing of these thoughts, give us a share and include a like if you can, and we'll contemplate doing these kind of evergreen videos more often. Okay, so I will wipe the face here a little bit now. That all goes. And I'll just pull in this particular chart and we'll expand it a little bit. Many people here are in crypto, but many people are in oil and other markets. The concept will be universally applicable to all markets, and we have done so. And my comments on time stops applies across market as well, in that once a trade becomes languishing, it usually ends up failing, and snatching any amount of the original hoped for R's usually turn out a good idea once the time frame that you've decided is up. I've done a very simple idea for you, and I said, okay, you want something on head and shoulders? I'll give you one. Why not grab the moment you first make the key level of significance of 47.5, and why not take the final down leg of the shoulder, which is the first interaction, even though it was a break and it feigned back. So there's a wick in there that you probably might not be able to see, that broke the 47.5, and you've got the small little rally here. So we take the first instance where you hop onto that ledge. You of course then have your left shoulder, which we've referred to many times on our crypto channel. This applies, as I say, this is not a crypto specific, that's your right shoulder, sorry, that's your head. It's not a crypto specific concept. This is something I've utilized on traditional markets, on and off on an extended basis on all commodities, FX, and a variety of other markets, equities, etc. And particularly as you start to be, if you ever elect to use options, you should be becoming more conscious of time frame and trade efficiency by time. Anyway, so I've highlighted two interactions. You would say this is the conception of the point. And this slide I did take from our premium content, so you're getting a little peek. And this is the triggering, and it broke and feigned back in and then broke for real there. We take the first point with the key level of significance. So basically we have defined when the pattern began forming and when the pattern first initiated its triggering event. You would have been tapped in there. I think the candle went that low. You would have had a small rally against you. Don't forget, on a head and shoulder, most people's stops are there. Had you entered early on the rising wedge, you could have entered in here, by the way. That's a separate moot point about maximizing your R's in traditional technical analysis patterns. We do actually do that, even though we are HVF specific traders, because often you might get a small time frame HVF in the top of that right shoulder that could be inverted and pointing to the downside. So maximizing R's in a trade and doing so in a very time efficient manner. So basically we said, let's say from the conception to the triggering, that is the entire gestation period of the creation of this pattern to the beige area. So it's to this point and that point, that is the beige square, and we replicated it forward into the future, and we allowed that amount of time. As you can see, our times never kill good trades, and reversals, when you first move after a lengthy bear, so a new move in a new direction usually hyper overperforms. And that is one of the reasons why I think Bitcoin is still languishing for a while and basing out, because this was after a lengthy bull market, the first reversal pattern of a major time frame. I think it's on the daily chart, daily time frame this. So it's a big result, and hence why you get a 55% correction from your all-time high, and you could have been short from 59 all the way to 29 on that break. So new move directions often give exceedingly high performance. Now, if we were dividing by the time allowed, that would have been an on-time performance, the glide path from triggering to there. This obviously represents an extreme overperformance. I've given it as an example to you. 50%, 25%, that would be 12.5%. You're probably at 6 or 7%. So the return of capital in what was, and markets throw down, and this is one of the key elements. There's a little subplot to this. Shorts can be amazing when you get them right, but many people get them wrong, particularly in macro expanding markets that keep on grinding up. Ask all the guys shorting the SPY index and the NASDAQ for so many years and continue getting killed for that one right trade. Most of them have their hearts broken, and it can be the same for Bitcoin. But eventually we had signs. I've covered this in Crypto Sniper, the marginally higher highs, the rising wedges, the first strike, and then the follow through. So that was super efficient. You would actually divide by 6.5 or 7%, 7.25%, half of 12.5, whatever it is, and your overall trade attractiveness for the momentum that it took down. So the R's didn't change, but the speed at which it delivered it was so super efficient that your capital was returned for you to use when you had allowed for an extended period that would have taken you out somewhere there. Can no longer read this because it's a picture of a picture, and you've overperformed. By the way, it was 93 bars of days, so you had 93 days to do it in, and I think you did it literally in a matter of 2 weeks. All said and done, singing and dancing. Yeah, okay, so that's one example how you could have built and established on a trade and had maximal overperformance, which showed that Bitcoin is probably, given the supreme overperformance, could have had another down leg, or is going to take a long time gestating getting over what was a devastating knockout first punch that was super high performance. Okay, thanks for watching this. As I say, share and likes. You want more information about how we utilize time stops with the HVF method and the HVF setup, and on other patterns and concepts, and also on your journey flight path to check in on your on-time performance inflection points. Are you on schedule, behind on any trade? Very, very useful feedback to have. It makes you more aware of a trade that might be running into trouble far sooner, and it ensures you cull your walking wounded. Okay, I'm Francis Hunt, the Market Sniper, the Crypto Sniper, and the Reset Sniper, although that channel is now on Odyssey, given a number of YouTube strikes. You can join us on any of those channels. You can also follow us on Twitter. Start thinking and start getting more efficient. Let me just give you a couple of points from a summary slide that we did do. This should form part of your pre-trade time-based expectations. So pre-trade analysis, how much time am I giving? You should write that down. You should commit it. And on your chart, like I have here on this blue zone, on the head and shoulder, it should be entirely self-evident. Recognize that also, it's not like your trade failed, good or bad. It's market feedback. You're never right or wrong. Market is giving you feedback. It's either endorsing your view, super endorsing it if it's doing it in a very short time frame. We mentioned getting into stable coin on that right shoulder. Or it's undermining it and showing you that there's new forces that are coming into the game, and it's giving you that feedback. So not only is it part of your pre-trade time-based expectations and your open trade management, it's point number 2, market feedback and analysis, and it will make you a more efficient trader. Point number 3, there are carry costs and opportunity costs. You should become more aware of these. They are very, very high, especially as you become a bigger and more successful trader. You want to become a more efficient trader. And these little compounding elements on multiples of trades over an entire year add up substantially. You should also do P&L assessments at the end of a 6-month or a year period to see exactly how you've been performing and where all your profits are going on things such as carry costs. Opportunity costs are harder to determine, but trades that are missed because you're fully committed on all your capital trades and haven't got leverage space or margin space to put on more is also a concept of thought. Allow a certain amount of time for a trade to perform. Trades that may set up, as I've already mentioned, can run into countervailing forces. This is feedback. So time is money. You should all have time-based criteria in your trades. We use a very specific method, and we have an example that we've given you on how you might create a time stop for a particular trade. You can go and play with that yourself of your own accord. Recognize that time stops are solely unique to HVF method. I actually know of no other method that is out there that is monitoring this. RRRT is a concept that is HVF method specific, and something that is unique to us. And good luck becoming a more efficient trader. Thanks for watching.